There's growing concern about a double dip recession. And you know, if there's a double dip recession, you know what that means for the stock market. I'll tell you whether we should, well, expect a double dip and why coming up. My name is Mike Bernard. I am the host of the Wise Money Show. I'm also one of the certified financial planners right here at Corhorn Financial Group. Thanks for being here. This is the Wise Money channel. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, so here's the deal. Here at Corhorn Financial Group, I wear lots of different hats. And one of the things that I love to do is help lead our investment research and our investment strategy team. And we call it our investment planning committee. And there's several of us here that are involved and participate in that. But one of the things that I do regularly is I go to the Conference Board website. Yeah, that's the name of it, the Conference Board. And I check out their leading economic index. So basically, going back years and years, decades, that board, that group of that organization created an index of different economic factors that tend to be leading economic indicators, which means they tend to be anticipatory, or these factors tend to suggest where the economy is going, not where the economy is right now or where it's been, where it's going. And they create this leading economic index, and it's an amalgamation of, I think it's 10 different items, stock market and some other economic factors that tend to suggest, okay, where's the economy going? And since the stock market is a leading economic indicator, the stock market moves before the economy does. I like to look at this, our group, our committee, our advisors like to look at this leading economic index, not as gospel. No one knows the future. No one knows the future, okay? But as a potential other data point to see, is the stock market moving in the same direction as it looks like the economy is moving? And so, of course, as everything took this sharp rebound after March, the leading economic index started rising as well. But I noticed on this report that the most recent one from July, it said leading economic index, the number was positive. I think it was by about 2%. I don't have it right in front of me. But the economists at the Conference Board said the growth is obviously slowing, and we have concerns about another slowdown happening in the economy. Things are plateauing. Well, the actual CFO, someone at the Conference Board, was interviewed by Yahoo Finance just yesterday and made a fairly alarming claim. So Bart Van Aert, that's a real name, that's a real person, he's incredibly intelligent, basically came out, and let me read what the quote that concerned me. As a matter of fact, we at the Conference Board, and again, kind of silly name for an organization, this is a group, this is a think tank, a group of economists, some of the smartest people on the planet, okay? As a matter of fact, we at the Conference Board do predict that while in the third quarter, which is right now, we will see the economy recover further, of course, the fourth quarter will actually show a slight dip. There, we, so the Conference Board, are really below consensus. And the consensus assumes that the recovery will continue. To me, there's tons of articles out there each and every day of people saying, watch out, beware of this, red sells, okay? But when a group of economists that I tend to respect, not because, well, they're always right at predicting the future. No one can predict the future. But I believe the inputs, I trust the input, I trust their process. When they raise a warning flag and say, we're seeing a potential double dip here, that concerns me. That concerns me, and I wanted to bring that warning to you because, again, if we're anticipating that it's just euphoria from here on out and the stock market's priced in euphoria, if we don't get euphoria, then it would make sense to have some, more prudent investment posturing today instead of jumping in on Tesla and the Apple split and going all in with tech, right? Here to me, there's three big reasons why I'm cautious about a double dip recession. We'll talk in a future video about a potential double dip in the market. But the three main reasons, number one is overconfidence in the midst of uncertainty. There's always uncertainty, okay? Obviously, no one can know the future. I've already said that, right? But there is significant uncertainty about where things go with this coronavirus, obviously. There is significant uncertainty about what's ahead with the election. There is significant uncertainty about the health of the consumer. There is significant uncertainty about the challenges and the tensions between the two largest economies on the planet. So there's all sorts of uncertainty. And when you've got such great uncertainty, for the economy to be surging, that is unexpected. I would typically, in times of great uncertainty, businesses are less likely to spend money or make big purchases. Consumers might hesitate or delay or avoid big purchases as well. And it's those hesitations, that change in behavior, that tends to drag the economy down. So I think this is one of the times in my lifetime of the greatest uncertainty. And so that, to me, makes me cautious about the economy moving forward. Second, and I sort of mentioned this, and that is tensions. Tensions about the global economy. When you've got the US and China, if you recall, over the last 3 years, anytime those two superpowers would argue a little bit, the stock market would go down. And anytime they said we've got a deal, or we tweeted, hey, we've got a deal, the stock market would go up. And then, oh, we don't have a deal, the stock market would go down. I mean, that's a big deal. With trade agreements and the global economy and TikTok and Apple and Amazon and all these companies trying to compete in the global marketplace, when the two largest economies are not getting along, that has the potential of dragging down the economy. Once again, delaying spending, hesitating spending, changing spending, all could influence the economy. That makes me cautious as well. And the third is fairly obvious as well. And I think what a lot of people are seeing is that the stock market is no longer a great reflection of what's happening in the economy. The stock market's really driven by these behemoth tech companies, and that is not a great representation anymore of how a typical business is doing. Therefore, I think the third great concern that I have about a double-dip recession is stimulus. Now, I'm not going out there and saying we need more government cheddar. I'm not going out there and saying we need the government to continue spending and they gotta inject us with another stimulus because we need another hit. I'm not saying that. I'm just saying the stock market being back to all-time highs, there's a lot of people and there's a lot of businesses legitimately struggling. And if there isn't the right level of aid to those areas, to the folks that need it and the businesses that need it, we will see significant contraction there, significant pain. More and more businesses will go bankrupt, and individuals will really struggle and end up foreclosing or missing rent and so on. And that will have a slowing impact on the economy. So those are the three reasons why I am cautious. And that cautiousness is connected to this economist group, the conference board that I trust, also waving the white flag saying, hey, we're a little concerned about what could be ahead. What does this mean for you? Hopefully you are making your financial decisions in the context of all 6 areas of your financial life, and that you're not taking too much risk, you're not being too optimistic, but you're not being too pessimistic as well. And that all of your financial decisions have synergy to them, and you know that each decision you make is making a positive impact on the other 5 areas, all 6 areas of your financial life. If you don't have that confidence and clarity, talk to your CFP. And if you don't have a CFP, you can always contact a member of our team. You can find us online, corehorn.com, that's Corehorn with a K, or also wisemoneyshow.com. You'll find us right there as well. Or you can even just give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.